Hi, my name is Motlatsi, and I look after the alternative investments unit in Momentum Investments. We look after a number of mandates. We look after hedge funds, private equity, high yield credits, and real assets. And our approach within these mandates is really to take advantage of uncorrelated returns, of unlisted premium, and also manager expertise within the unlisted space. What I intend to do today is just walk you through what's happened over the last month or so. So since say beginning of March up until the end of March of the first quarter, to give you an idea of what's happened in the portfolio over that time, and to give you up bring you up to speed with what we're doing going forward. Now, starting with private equity. In private equity, the mandate is quite simply to get uncorrelated returns, to give investors access to cash flows and to portfolio companies that ordinarily they wouldn't have access to. We use the same investment approach used in all of Momentum Investments, so we look very much at outcomes-based investing, which means that we're looking at long-term return outcomes. Over the last quarter, we were busy with the rollout of our Fund 3. That's a 2.5 billion private equity fund, which we've actually committed a significant portion of the fund, close to 95% to be exact, which means that it's almost complete. But we started throttling down, I guess, from about quarter 3 2019 on investment allocation and committing the fund. Which has actually turned out to be quite fortuitous in the sense that we now have a bit of dry powder and a bit of capital available, which capital we can use and we've been using to help our portfolio managers and their portfolio companies during this very stressful cash flow period. Our funds have reacted differently to the current lockdown and to the pandemic in general, where some companies have had to close down totally. Others have managed to carry on with their operations because they're involved in providing essential services. While other companies have actually been impacted more by the currency devaluation rather than the lockdown per se. So as you can see, the impact has been different depending on which portfolio company and which specific exposures you're looking at. But all in all, the performance has ranged from about 3% to as much as 15% down within the portfolio. And at the extreme end, at that 15% down, this has actually been as a result of exposures that our fund managers have to listed counters, so listed equity that they have in their portfolios, which has had to be written down as a result of the market sell-off. Explains what the accounts for the 15% write-off in our portfolios. We've been very close and interacting quite regularly with our fund managers. They've been keeping us up to date with what's happening with their portfolio managers, and we're quite comfortable with their level of how proactive they have been and how they've acted with urgency in dealing with their portfolio companies. First of all, interacting with them daily to manage the issues around the pandemic. And also making sure that they have enough cash flows and resources available to tie them over, whether it's for the 60-day period or for the coming 2 or 3 months until they're back on their feet again. So that's worked out quite well. It's working out quite well. I guess we'll know the result later on. We're also part of an industry initiative within private equity where we are making facilities available to fund managers and their portfolio companies. To give them access to working capital to tie them over, especially companies that have been adversely and significantly impacted by not having cash flow during the lockdown. But hedge funds, our hedge fund strategy is also very similar. We look similar to what I described earlier. We're looking for asymmetric payoff profiles. We use more or less the same investment process, outcomes-based investment philosophy. And in essence, we're looking for uncorrelation. Our solution when it comes to managers is very specific. around what strategies can help us with getting as much of the unlisted, not the unlisted so much as the risk-adjusted payoff profiles from those managers. Now, hedge funds have been the most adversely impacted by what's happened over the last few weeks or so. While the strategy has been for uncorrelation, what happened is that over March, effectively all asset classes converged to one. So correlations all converged to one, and which sort of meant that the hedge fund strategy, or at least objective, came undone. So hedge funds were not able to provide the kind of protection that we were looking for, in the sense that they moved more or less in line with the way markets moved. So to give you an idea, our active profiles, for instance, performed more or less in line with markets. So we, at the worst cases, markets went down about 33%. Some of our exposures went down the same way. And for our tracking exposures, also performed in line with the trackers, and those were down about 51%. So all in all, it's been a very difficult period for hedge funds. And unfortunately, we felt each and every one of those moves down. It's been quite unfortunate in the sense that, as I explained, that we sort of moved exactly in line with the markets, when in fact the strategy was to go against markets when markets ran. However, on the positive side is that it's presented a number of opportunities. If you think, for instance, in the relative basis space, in the credit spread space, where these have blown out quite significantly. It's meant that our managers who are active in those spaces, are able to take advantage of the current dislocations, and they're already doing that. So, in some way, we are covering some of the ground that we lost over March, and hopefully, the numbers come the end of this quarter will be able to compensate for the losses of March. Our high yield strategy. This is our special opportunities fund. This fund, in essence, is looking for, or at least is chasing, unlisted, illiquid, and long-term credit exposures. Right? It's a high-risk portfolio, so it's looking for returns of about 6% over CPR over rolling 6-year periods. So the theme here is very much on the long-term end. I can happily say that this fund has experienced very little of the volatility that happened over the March period. So the fund in total ended the quarter about 4% up, which is very good given what is happening all around it. So we've been able, at least in this strategy, to be able to capture some of that uncorrelation and be able to capture the effect of being unlisted, in the sense that we don't experience the same volatility. And also, our managers in this space, high yield credit, are also taking advantage of the blowout in the credit space, where they've been able to pick and choose effectively what they want to invest in, given the abundance of opportunities at this time. So we're still quite positive on the strategy, and as I said, we'll be allocating quite opportunistically to whatever comes up that meets our return targets. And then our real asset portfolios. These portfolios have a comfortable place of having contracted cash flows. So they're contracted either to National Treasury, Eskom, the National Students Financial Aid Scheme, which means that they don't experience the kind of volatility that the other portfolios experience. So there isn't much happily that I can report on this one. It's still chugging along quite nicely, and we're quite comfortable with that. However, suffice to say that the impact of the lockdown, and I guess of the pandemic in general, will be long-term in nature, and also will manifest over time. So we'll get a better picture over time of what the impacts of how it translates into the real asset portfolio. So all in all, in conclusion, I guess my message is that it's been a very difficult quarter. March was a very difficult time for most of our strategies, in particular hedge funds. But we're quite positive that the opportunities that the dislocation has presented are quite favorable, and our managers are in a position to take advantage of those opportunities, and they are beginning to do so. And also that the impact will understand it over time. We'll know for sure, looking at the different scenarios on how they pan out, how it will impact our portfolios as we go on. So hopefully at our next update, I'll be able to give you a better picture and a better understanding of how that's worked out in our portfolios and how we've mitigated some of those risks.